Thank you, Prashant and Pankaj, for being on the stage. It's a illustrious panel. Thank you all for listening in. So we've got about 1 hour for the panel. The topic is investing in Indian equities, past, present, and future. So in the 1 hour, what we'll try to do is we'll focus on 3-4 topics. Investor trust, then we'll go to short-termism. We'll of course talk about markets. Everybody's keen to listen from both Pankaj and Prashant, their views on markets. And then we'll try to look at the regulatory side of things also. So 3-4 topics. There's a list of 7 that Professor Badri has given, but let's try to cover 4 of these. And let's try to ask some tough questions. So in the Q&A. So shall we start with the first part, which is, can we start with markets first?
Sure.
So let me go to Prashant, and you've been for 28 years. You've had a solid run in the equities market space. I wanted to get a quick synopsis from you on the past, present, and the future. What is working in the equity market space? What is not working? You've seen several crises, some booms. What should students and attendees over here take away from your experience?
So I think equities are a very simple asset class, but they are not easy. And that applies to a few other things in life, but let me try and explain what I mean by this. If you look at the history of the Sensex, it is simply compounding around the nominal GDP growth of the country. The Sensex started in 79 and today it is 36,000. Starting value was 100. It is up 360 times. If you work backwards, this will come to around 15-16% per year. So earlier India used to have low real growth, high inflation. Last few decades we have higher real growth and lower inflation. But the nominal GDP growth of India, if you add the real and inflation, has been remarkably constant across all periods. So, and when inflation is high, purchasing power reduces, real growth comes down. And when inflation is less, interest rates are less, EMIs are less, the real growth tends to go up. Of course, we know the long-term drivers of Indian equities: population growth, breakup of joint family system, more nuclear families, increasing affordability and stuff like that. So I think equities, this way, if you look long-term, they are extremely, extremely simple. And if you look at equities this way, it does not matter whether equities are manipulated, whether they are speculative or not. It does not make any difference. I mean, any amount of speculation can come and go. I can assure you no one can manipulate equity prices over long periods. The biggest individuals, the biggest institutions will fail. But of course, over short periods, it is amenable to manipulation. But I don't think it really matters, because the difficult part about equities is that they are very, very uncertain over short periods of time. See, for every trade, there is a buyer and a seller, for every trade. So unless two people think exactly opposite, there is no trade. So if you just look at the mechanics of a trade, it is telling you that for every trade, someone will go wrong and someone will go right. The challenge with human mind is that each one of us wants to be right in the short run. But the averages are telling you that you can't be right in the short run all the time, at best half the time, which is no good. So I think the key to understanding equities is to understand the compounding nature of equities. 100 compounded over 40 years at 15% becomes 36,000. If you had compounded at 8%, it would be 2,000 rupees or something like that. So I think over long periods, equities are really simple, and over short periods, I don't think it really matters, because your guess is as good as mine, is as good as Mr. Warren Buffett's guess, because that is the real essence of equities.
Thank you. Can I go to Pankaj? There's this concept of multi-bagger stocks. I don't know if you all have heard of it. It's the buzzword. So I would like you to comment on multi-bagger stocks. And is that a possibility? What percent of the market are multi-bagger stocks? Should people run after multi-bagger stocks, or should they just go after the Nifty index and sit tight?
So, meaning, why shouldn't you run after multi-baggers? All of us at the end of the day want the best possible, the highest possible returns.
How many are there? How many of the stocks are multi-baggers?
So the point is, as Prashant said, investing is a very long-term game. While you can punt in short-term or try to speculate and try to, there are a lot of people who come to stock market with the Dalal Street or Wall Street who want to become millionaire overnight, and unfortunately, majority of them or most of them, don't have a good experience. The point is, when you're investing, while we are transacting through stock exchanges or we are buying stocks, please do remember, every time you're buying a piece of stock, you're buying ownership rights, minority ownership rights in an underlying business. Yeah, what you see in stock prices, as Prashant said, in short term stock prices are uncertain. Also, we need to understand market is a collective place where all of us dealing or trading or investing are all human beings, and we are driven by the common psyche of greed and fear. So unfortunately, as much as we desire, human beings tend to be irrational. They don't tend to be objective in their decision making, and which is what presents the biggest opportunity in markets, where there is always someone out there who's behaving irrationally. And if you are a long-term disciplined investor, that effectively means that creates opportunity for you, because you can buy businesses at prices which could be very attractive from a longer term perspective. Just give an example, meaning over the last few weeks, there's been a lot of this noise on, there's been a lot of media articles on 10 years of the GFC crisis and the Lehman. When the Lehman happened, actually I used to work with Merrill those days, so I've, in a sense, lived through that crisis and have seen that crisis every day evolving, because Merrill eventually became part of the crisis. And I'll just share one statistic with you. So if you bought any of these large US banks, let's say a JP Morgan or a Wells Fargo, on the very next day Lehman went bust, okay, which was I think 18th of September, the Friday was the Friday, meaning I was in my office till midnight, Monday when markets opened, Lehman went bust. 20th of September, if 20th of September 2008 you bought any of those stocks, let's say JP Morgan or Wells Fargo or any of these stocks, you would have lost like something like 20% over the next 1 month, even after buying them at a point where they were already down like 50%. But if you would have held them until now, you would have still made 14% CAGR. Exactly the point Prashant made, So all I'm trying to say is, while it's good to have that aspiration to multiply your money, the most important thing when it comes to business of, and I say investing is a serious business, is you buying underlying business. So have a disciplined approach to investing. And if you do that, I'm sure all of us in a long professional career comes across a lot of businesses which at time, do exceedingly or amazingly well over a period of time. And if you got those businesses and if you bought them at the right price and you just sat them over it, they eventually tend to become multi-baggers, So all I'm saying is there is, while you can punt on stock prices, but if you want to multiply or compound your capital over a longer period of time, there is a finite process and a science to it. And if you can follow that disciplined process, it's not so difficult. Meaning there are a lot of things in the world which are far more difficult than investing or investing into multi-bagger stocks,
No, thank you. So, just to give you a perspective, if you look at S&P 500 from 1926 to 2017, all the gain in S&P 500 was just explained by 4% of the stocks. So that's from Barron's. Now coming, and the statistics is similar. I don't have data on my terminal these days, but looking at some of the newspapers, I found that it's probably around the same. And Prashant and Pankaj can either confirm or negate that finding. So 4% of S&P 500. I'm not sure how many percent of the BSE 100 or NSE 100 are contributing to the entire gain in the last 30 years.
So I have not done that analysis, but I have experienced markets since 91. I don't think that would apply to India. But what I have experienced is that at a particular point of time, bulk of the returns could be driven by a group of stocks. Like from 95 till 2000, bulk of the returns were driven by the technology, media and telecom stocks. From 2001 to 2007, I think, bulk of the returns were driven by capital goods, banks, metals. Between 2007 till 2015, I think the FMCG, pharmaceuticals, and banks drove bulk of the returns. And I think now again we are probably entering a different cycle. But if you look at a longer term period, I think any business which has grown over 10, 20, 30 years has contributed to the GDP, and it has contributed in similar measure depending on its share of economic activity to capital markets growth and wealth creation as well.
Thank you. So, sir, you had a very interesting quote, touchstone and tombstone, and fear and greed. How should the audience think about it? Prashant is saying that yes, there is a positive skew in the market. People can go after the positive skew, and there is this option of going after 15% index returns, or 13% rather. So, what is your take?
Well, I mean, I don't know if is this working? Yeah, I think so. So I want to react to a couple of things too. As a teacher, what finance textbooks tell you is don't put all your eggs in one basket. Diversify, buy some broad-based index and be a long-term investor and go about it. And if you think for a second, what is the opposite of that? The opposite of that might be put all your eggs in one basket and watch that basket very, very, very carefully, right? And that's the notion of the multi-bagger. That's the notion of, if you find those multi-baggers and you're willing to do your homework and sit on them for a long time, there have been investors who've done well with that strategy too. The diversify all, this is what the textbooks preach. And for most of us who are not investment wannabes, I think that's probably okay. You don't like this stuff, you don't like looking at accounting numbers, you don't like looking at businesses, you don't like looking at financial statements. Diversify and be done might just be the prescription for you and you're okay. But over the long term, like both my friends on the other side of Srinivas said, everything becomes a multi-bagger. And so that's one thought that comes to mind. And the second thought was something I was sharing with the media person I talked to a little while earlier, and some of you might have heard me tell this story before. My dad is the classic Rip Van Winkle investor. He's in his 90s. A few years ago, when I came back to India, I'm like, Dad, you need to write a will. You're getting on, write a will. So after much persuasion, he writes a will. And in that will, he's putting down bank accounts, assets, and one piece, then he says stock portfolio. I'm like, you have a stock portfolio? And this is my father. He says, yeah, I've owned these stocks for decades. Show me what it looks like. I'm a finance professor. I'm an investments type, for God's sake, right? And his dividend comes down, what is the problem, And he's been sitting on some real blue chips in India for a long time, and he's just never looked at them too closely or too carefully. And that's the easy model in some sense. The harder model is if you want to watch them, you want to react to, every little tidbit of news that comes around. Earnings season is like a big confessional period every quarter that, even Donald Trump is now saying maybe we should do this every 6 months instead of every 3. So there are different ways that you can play this game. And I think for people, you have to figure out what kind of risk taker you are, what kind of horizon you have, what kind of goals you have. And you have to watch my pie videos, right?
Thank you. So, watching pen dry. So let us go back to trust. And again, in the sense that Indian equities, past, present and future, what is happening to trust? To give you a perspective, CFA Institute does a annual survey with Edelman Trust, and it's a global survey, and the financial services industry is at the rock bottom. And the second in place after the financial services, you could guess, it's the media.
Lawyers?
Sorry?
Lawyers don't come in there somewhere?
So let me go to Prashant and find out from him his thoughts about trust. In the past, just to put one more perspective, Prashant, what would Mahatma Gandhi think about trust?
See, I think in any industry there would be individuals and players who would probably not act in a most upright manner, and there is a full grade from upright honesty to downright crookedness. And I mean, so I can't say that in financial services there are no challenges, but I think our regulator has done an outstanding job. And let me speak about mutual funds. And I think Indian mutual funds, I feel, are one of the best regulated, and they are the most transparent. Your expenses are capped. In India, you can buy funds with no loads. Loads were eliminated few years back. SEBI has dropped expenses few weeks back because scale has grown. Our portfolios are made public, 100% of the portfolios every month. It happens in very, very few countries in the world. And I think, I mean, I've been part of this industry. Sometimes we feel there are too many audits and stuff like that, but I don't see, I mean, any meaningful scope for lack of trust in this industry, and that is why the industry has grown. See, ultimately, the proof of trust is how does a product or an industry behave over time. So mutual funds used to own close to 0% of Indian capital markets. We have come to 5, and this number is going up. And that's because people who have invested in Indian equities, bonds, I mean mutual funds, they have got returns commensurate with their expectations, at least over long periods of time, and they've had a good experience. That's why they come back, and that's why, but I also agree that in India, financial literacy is extremely low. You can go to the senior most bureaucrats, senior most doctors, lawyers, whatever, but the financial literacy with the most educated people is much below desirable levels, and lack of understanding could lead to wrong decisions, and it could in turn lead to lack of trust. For example, mutual funds are open-ended. You can come in and go out any day of your choice, right? But when you come in is your decision. Now, if you come in at a wrong point of time, then it could lead to a lack of trust situation, but probably for the wrong reasons. But I think by and large, mutual funds in India, I think are extremely well regulated, very secure, cost efficient, and extremely transparent.
The question is, I mean, we can get that question to Pankaj. Why does the regulator have to regulate? Why can't the industry self-regulate? Why does the regulator have to cut expense ratios? Why does the regulator have to do things? So, I mean, it's not just India, because as Badri sir pointed out, it's there all over the world. We've seen the Lehman's happen. You've seen what's happening, I mean, on the Wall Street banks. Huge amount of fees have been paid. So for a country which has got a culture of trust, actually, if you look at our ancient culture, there's an ethos of trust. But somehow the financial services marketplace, I mean, there are fine people like you all in the industry. What needs to change?
So we need a regulator, meaning at the end of the day, human beings have animal spirits. So there'll always be people out there who would want to find a shorter route to, or there'll be people out there to game the system. And I'm saying, why blame financial markets for that? Those kind of people exist in every industry all over the world. So obviously you need someone who's watchguard, who's setting the rules, or meaning you call, why do you need a referee in a match? Meaning let the players play amongst themselves, You don't need a referee in a football match or an umpire in a cricket match. Let a player, if he's out, let him just walk out, But how often will you do that, So you need a referee to make sure it's a fair game and the rules of the games are followed. So to that extent, and as Prashant rightly said, see, all industries, all markets go through their own evolution process. Badri highlighted Bernie Madoff, right? It shook the world, meaning it was $50 billion. Yeah, $50 billion, meaning that's like, and obviously while we have had our shares of Satyams, just think about Voltel and Enron. They were like multiple times the size of satyam. So all I'm saying is, if you look there, and it's so the point I'm trying to say is things like this happen even in developed markets like US, because at the end of the day, as they say, human beings have animal spirits, and there are people out there who are a step ahead of the regulator, who are wanting to game the system. So you need a referee. But having said that, I think our markets have evolved, and in some aspects of regulatory, some aspects of regulation in the way some of those regulations are, probably India is a step ahead of even developed markets. You don't have fee regulations and stuff like that in developed markets, where you still allowed, meaning funds can charge what they want to, because it's like a buyer beware concept. Where, but in India, the regulator is of the view that markets are still evolving, and he believes that investors are still not well informed, or they're naive, and he's out there to protect those kind of investors. So he's been slightly, meaning a lot of regulatory changes in India are actually now in a lot of aspects of markets ahead, or probably more regulated than some of the, developed markets are in that sense. And I think, meaning we still have a long way to go in terms of the growth, because allocation of household equities to household savings to equities in India is still in single digits. So we have a long path. As long as the markets remain well regulated, that will inspire confidence of more and more investors, and that's what we need. We need a robust capital market, because that's a backbone of the economy, because that's where we'll find the risk capital to fund the growth in the economy. So and in that sense, I think if you see over the last 2 decades, except the last, the mishap we had in our markets in 2000, markets have done reasonably well. We haven't had any big, something going wrong with the regulatory side of the market.
Thank you. Sir, do you agree with this concept that you need a regulator? And also, what is your view on investor education? Can that play a role in building trust?
Okay, I want to go back to trust for a second before I get to regulator, right? And, having thought about trust while I was making up this slide, the academic that I am, I go out looking for evidence. And I come across this thing called the World Values Survey. And this is a group of social scientists in Vienna, very reputed, very respectable guys, who go around and ask large samples of people in various parts of the world, in every country that they can get to. Things about values, what do you think about faith? What do you think about religion? What do you think about hard work? And one of the questions, obviously, that is of relevance now is, do you think most people can be trusted? Okay, and the response varied hugely from country to country. The mean response was 24 or 25%. China came out at 48, Hong Kong, Singapore were in the 40s, so Scandinavian countries were in the 60s, India was at 16, 1/6. And I said, okay, this is everybody, we were saying we all trust each other, we are trusting people. Maybe it's oxytocin in the brain, whatever it is. Pakistan came out at 22%, and I had to share that because I've never quite figured out why Indians get very happy about beating Pakistan at anything. But 16% is sad, it's abysmally low. And then I start thinking about this some more, and I'm like, we say trust, and this is, can most people be trusted? And I think, there is a notion of, individual trust, and we trust people around us, our friends, our families. But when it comes to trusting institutions, I think this is where this in India especially breaks down, right? That is that is my trust story. So I was really surprised at this survey, and I didn't think India would show up this low. But 16% was, I did another thing. So this was like wave 6 of the survey. So I went back and looked at the same survey 25 years ago, in the 80 to 90 period somewhere. And there India ranked 37 or 38%. So if anything, trust in Indians are becoming less trusting rather than more about each other. And that is not a happy commentary, people, Okay, that's the trust side of the story, right?
Yeah, so what's the solution?
I don't know, Baba.
So will education, what do you think if you were to have a hypothesis?
I think at the personal level, they are fine. It's the trust in institutions that's the problem, right? And that's, and I don't have statistics, I wish I could break that questionnaire down into, because I think on an individual basis, we all think of ourselves as trusting people. Right. But we don't trust the institutions around us. And that is why investors are not participating in markets, because it is that same lack of trust story, right? So part of it is education, part of it is the role of the regulator in, fixing mistakes, errors, scams as and when they occur. And I started to say this in my slide, but I don't think I said it very well. I think that, Ketan Parekh and Harshad Mehta and Nirav Modi were the same scam. One called them pay receipts, one called them pay orders, one called them LOUs. But it's the same scam over 3 decades. What have we fixed? Is the we understand that regulators have to be behind the curve. Innovation keeps rapid pace with everything else. But we can't keep having the same crisis over and over again and then hope that the regulator is doing a good job, right? That's really kind of what I think. Right?
Thank you. So we're about halfway, at the halfway point. Should we just quickly go for a round of questions from the audience? Yes, sir.
Last point, that how people don't trust institutions, or institutions have a tendency to exploit the relationships. I was only thinking it's a matter of time that maybe the people responsible to manage institutions, either the leadership or the board responsible for action, are they not playing their roles very effectively? Or leaders see that I'm there only for temporarily. I'm there for 2 years. Let me show something which is positive and I will go on. And the process he gives the institutional processes which lead to the trust confidence. And let me stop.
Sir, this is a topic with an issue where opinions will matter more and data is hard to come by. But if you actually look at data, so banks have been doing very well. And what are banks about? They're about your trust in the bank. And people blindly trust banks in India, right? So, and I don't think we have had any challenging situations there. What Professor Saab was mentioning, it relates not to the banks. It relates to individuals having taken money out of and these individuals will always be there. But think of it, in 40 years of history of capital markets, if you have had 2 situations where people have accessed bank money and inflated stock prices with that, that's about it. It was a lapse on the part of the bank to have given excessive credit lines in whatever form to these 3 individuals. But I don't think it's a failure. You will say lack of trust in the system. And I can turn around and say, look, Harshad Mehta and Ketan Parekh were my best friends ever. Provided I did not lose my sense of right judgment. Because they gave me the opportunity to sell a stock which was worth 100 at 1,000 rupees. But if I chose to buy at 1,000, then why should I blame Harshad Mehta? And that is what happened. Because of your lack of right understanding, because of your greed, because you wanted to double your money overnight, you bought the most expensive, the most terrible stocks with weak quality, weak balance sheets, weak track records, then why do you go about blaming anyone else for this? So I think if you look at insurance, it's a growing industry for 50, 60 years. If you look at mutual funds, they have grown from almost nothing in 20 years to maybe, I don't know, maybe some, how many lakh crores now? 3 lakh crores? No, it should be more. It should be much more. We ourselves are 3 lakh crores. So the largest corporates in the country are trusting mutual funds. So I don't think it's a issue of trust. What he was raising, that is a societal issue. So, don't we feel challenged with the medicine doctors? Don't we feel challenged with your garages? Don't you feel challenged with your contractors? And it has seeped in all aspects of the society. So I don't have an answer for that. But I do feel that financial services in India, by and large, is reasonably well regulated, is quite transparent, and people do trust. And that is why these institutions have come to such a size and scale. And I think I would rather go by that than few surveys.
interesting point.
Can I respond
So,
to that too before we go further?
sorry?
Can I respond to his question for
Yes,
2 seconds?
yes.
So, you know, in England, they actually have something called the Financial Conduct Authority. And their mode is to sort of encourage, you know, institutions, the boards, to make them sort of responsible for the better financial conduct of their employees. So if you get governance to have a little more skin in the conduct game, then maybe episodes like the ones we're talking about might become fewer. But that was all I
Sir, may I come back to you? People from that side are leaving the room, so I wanted to just...
Make sure they don't.
no, I mean, no.
Lock the doors.
Do you have any questions? Anybody from that side, students, any questions? Yes, sir. Yeah, no, why don't you ask? Great question.
So the question
So
was
foreigners have left the mutual fund space from India.
Is it because India is too small to play in, or because they were unable to play in India was the question, right?
So India was smaller when they came in, and it was bigger when they left.
Yeah.
So it was not a question of size. India is today the world's 5th largest economy. So I don't think there are too many economies bigger than India. I think the issue was that they were not able to compete in the marketplace, that's it. And what has also happened is, even globally, some of the banks, the insurance companies, they have moved out of the mutual fund space. So I think it is partly global and partly inability to scale up in India. And mutual funds, if you appreciate, is a very fixed cost business. And unless you get scale, you will not make money. So I think if you are not able to scale up, and again we come back to that factor of trust. See, a foreign brands have a disadvantage here over local brands, where the element of trust is more. So all other things being equal, local brands will tend to do better.
Can we go to sir?
Thank you. I have 2 questions for the panel. First, you mentioned about compounded growth rate in the equity markets in India at somewhere 13-15%. How do you see this trajectory growing forward? So if we were to put the clock up to 2039 or 2029, where do you see that trajectory? Question 1. Question 2, why is it that while our equity markets have grown by leaps and bounds over the last 15-20 years, we have hardly seen any growth in the debt markets? I mean, corporate bond markets don't exist. We only trade in government securities. And the next stage of growth for mutual funds would be creation of more balanced funds, which is able to switch between these 2 markets. Why is the debt market in this country so insipid and lacking growth?
Right. So you want to take Pankaj and then Prashant, or maybe Prashant first? Yeah. Okay.
Yeah, to the second one, I'll give you a very different perspective. But actually, Pankaj, you can answer the first one.
So, if you look across the world, many equity is just a derivative of how an economy and underlying businesses do. If you look across the world and the history of the world over the last 200 years, every country has gone through a cycle where over a period of 20, 30 years, they've grown at a very high rate, and they've evolved from a emerging or a developing country to developed economy. This happened to Japan sometime in the 70s and 80s, when they were the fastest growing economy in the world, when they ended with a big debt bubble. US had its time between 80 and 2000, when it grew at a phenomenal rate for 20 years. And of late, China had its cycle, meaning if you go back, not very long back in the history, meaning I'm sure some of you know it, India and Chinese economy were of similar size. And there was a point of time, probably sometime long back, where Indian economy was bigger than China. The Chinese miracle, whatever happened, it actually started taking shape from the early 80s, and from late 80 onwards, China has had double-digit growth for 20 years, and which effectively meant they are now the second largest economy in the world. I think if you look across the world and the way some of these long-term factors are playing out, it's my view that India probably will be one of the fastest growing economy for the next 20 years, and probably the only economy, only economy and the third economy in the world which probably will get into the $10 trillion club. Today you have US and China, and the only economy which will get into $10 trillion plus kind of a size probably will be India. So if you see all of that backdrop, then I don't see any reason why Indian equities should be the best performing asset class, not only from a Indian investors' perspective, but I actually think it from a more global perspective, that Indian equities should be one of the most attractive asset class from a global perspective. And keeping all of this perspective, I don't see why we should not compound at least at the same rate at what we have compounded in the last 20 years. If at all, if you really ask me, my expectation would be we should do much better, because our growth will be much faster on a much bigger base over the next 20 years than what it has been in the last 20 years. So,
sorry to, are we really the best performing equity market in the world? If you take from 2008 to 2018, dollar adjusted, we have actually underperformed US.
So what I meant was in INR, I understand when you talk in dollar terms, but I think if you take a period which is like more going back from 2001 onwards, we'll be amongst the second or the third best performing markets, even dollar adjusted. Kind of. So I'm saying when you look at returns, look at a slightly longer cycles. And also there are a lot of transitions that have happened in the Indian economy, especially in the last 3 or 4 years. So I think, there is no reason why India should not be one of the most, Indian equities, why it should not be, to my mind, it's the most compelling asset class. When I look at it from the next, when I look around the world and when I look at it from the next 20 years perspective.
Thank you.
So I think economy will grow around similar rates in nominal terms. That's what I feel. See, in India, only 10% families own a car. And that is telling you how much headroom is there for growth. I think at some point of time, this country might face a challenge that we are under-investing in R&D. See, the biggest stage will come when your basic, unless you develop global corporations like Apple, Google, there are so many of them. So you don't find any companies in India which have innovated really effectively. So I think we will grow for the next 5, 10, 20 years. But to go to the next level of the developed countries, I think we will need to innovate, and that time will tell. So while I'm extremely optimistic, I think it does not hurt to spare a few hours every year and kind of monitor how you are doing as a country. Coming to bond markets, I have a very different take on that. What is the name of a debt scheme in India? We call it fixed income scheme. But it's an anomaly. The fixed income mutual funds are not giving you fixed returns. Because of the collective efforts of industry, media, regulator, we have been able to explain the volatility in equities to the Indian investor. But we have failed to explain the volatility in fixed income to the investor. And in a way, I feel he is right. He says, look, my risk capital I am giving to equities. What is my safe capital? I want to invest in a fixed income instrument. So why should I make that safe capital risky? And that is why I think the fixed income mutual fund business has not grown. And unless the retail capital comes into the fixed income mutual funds, how do you develop the bond markets? You can do whatever you feel like, but ultimately who is going to buy those bonds? So I think that is the fundamental problem we have in this country, and I don't have a solution to it. And in a way, the retail investor is right. He says, look, safe capital, I want fixed returns. And mutual funds can't offer me fixed return. If you look at last 1 year, returns are 0. And I mean, logically he's right. If bank FD is giving me 8-9%, what's wrong with it? It is my safe. He does not care about developing the bond markets or not.
Thank you. Can we go to, you had a question, right?
The question is to Prashant. Prashant, I know that HDFC Mutual Fund has the DNA of an active manager, and without getting into that debate, I think there's one opportunity, and I know it doesn't exist maybe, that is to provide on the passive side a feeder to US S&P 500, which really doesn't conflict with this debate really of active versus passive in India. The fact that you all don't have it probably means there may not be demand for it. Wanted to get your take on, is your sense that there's no demand, Indians just are not interested in investing outside of India?
See, a time will come for that. Today, as Pankaj said, Indians are investing about 4 to 5% of their household savings in Indian equities. I mean, so don't you think it is premature to ask them to start investing in US equities? So I think first you take them from gold to bank FDs to equities to bond funds, then you can take them to global equities. And see, I don't have a great understanding of US equities. So the confidence with which we can connect with investors on Indian equities is far higher than we'll have to invest in developing that capability. And I don't think we have done that yet.
Can we take one quick question and then go to one round of short-termism?
Sure, if you want. Yeah, there's a question here. Over there.
So, actually, I would like to ask two things. One is, do you think that individual investors have an advantage over institutions when it comes to managing their own money? I mean, not being restricted by all this regulation that you were saying. And the second thing is, it's kind of related to that regulation theme, is that isn't it possible that a more self-regulatory mechanism can be followed by asset management companies, and with the regulator having to step in only as a, only in case things go very wrong, instead of being prescriptive, telling that expenses should be fixed at this or so on and so forth, which becomes very interventionist in a way. Like for instance, the media companies self-regulate in terms of what things are shown on television. I mean, it's politically sensitive or things that are against the peace, they are actually censored. So similar, isn't a similar thing possible for the asset management industry?
Pankaj, you would like to, or Prashant? Pankaj? Yeah.
I think the day the investor is very evolved, he is financially very literate, he understands what he is buying, he can appreciate. I think you will get answers to that over time. But at this point of time, when we are struggling to educate the masses about the volatility in bonds, it just might be too premature. But I think maybe a time will come for that. Pankaj, you want to add something?
No, just only thing is, when you compare it with media, see, that's something which you use as an entertainment. This is a business where people are trusting their hard-earned or lifetime savings. So while meaning it's idealistic to have a football match where you don't have a referee and players can regulate themselves, but unfortunately, so. Yeah,
it's regulated.
That's what I'm saying. You need a referee. You need a referee because it's a business where people are trusting you with their lifetime savings. So you need a referee. Sorry, what was your first question?
Managing their own money. Managing individual investors, managing their own money versus institutions.
Theory is very different from practical. So that's so while in theory you might say कि I will have more flexibility, but I can assure you that, and I am not saying because I am in mutual fund, but I have experienced it in friends, relatives. See, if you understand equities the right way, of course you can do as good or a better job than a manager. But the challenge is in equities to understand that what I don't know, that itself takes 10 years. And that is the biggest challenge. And the proof I will give you is, just look at the most popular investments by retail over cycles. And you will find at the peak of every cycle, retail is the biggest participant in that cycle. What happened in technology, right? What happened in 1992? Same thing. So I think there are, of course, if you talk about one out of those 100 individuals who is really financially literate, evolved, I mean, he will do better. But here, I don't think it would apply for the averages.
Let's go to a quick round of, yes sir.
They did some recalc.
I don't think so, sir. Sir, I don't think you are right, sir, but I
stand by what I said. So the entire returns perspective changes.
Sir, why does someone not Google and look at the history? I mean, nowadays we know.
But the point is, I mean, if you try to
Sir,
take...
I can give you another perspective. We have 3 or 5 funds now coming close to 25 years of history and which have given a CAGR of 19%.
So,
The NAVs which were 10 rupees are now in 500, 600, 700s. And there are many schemes like that in the industry. But I will go back and check, but right from my day one, I have looked at the history of Sensex. I thought it was 100 on 31st March 1979, but maybe I will have to go back and relearn. Yeah. That's okay. No, what fund managers are, where are they saying, sir? Yeah, but index you can work backwards. No? If you have the history of stock prices, what's wrong with that? If I have the history of stock prices, I can work back and recreate the index.
So, okay, point made. Let's go quickly to...
No, I think let me just address that because it deals with the element of trust again.
Yeah.
Okay.
Yeah.
Right? So, sir, many stocks are not a part of the index. So what's wrong with it? I mean, businesses, if they don't survive, they will move out of the index. As you evolve as a society, if you have stopped driving a bicycle and you are now driving a car, of course the cycle index will move out of that index. So nothing wrong with that. But fact is, if you had just bought the index itself, it has created that amount of wealth. Whether you bought in 79 or 86, whether index was recreated or not, I don't see any of that impacting the merit of the index. And you can go and check the history of Dow or Nikkei, and those indices have delivered returns close to the nominal GDP growth, or in fact at many points of time in excess of that. So I don't think you can take away the compounding nature of equities.
No, and just to add to that, I think long term also is in the eye of the beholder in some sense. If you look, we don't have a long enough history in India, but if you go back and look at, US returns, there have been periods in the US history where indexes have delivered nothing for 15 and 20-year periods. Those are the graphs you never get to see, but if you actually
No, sir, it was in India also. But I will tell you, there is a very proper reason. And see, if you look at in 1988, the index was 400, the Sensex. In 1992, it was 4,000. In 4 years, it went up 10 times. The nominal GDP had not even doubled. Indian markets, that was the point where the market cap to GDP was the highest ever. Markets were trading at 40 PE. After that, all bull markets have peaked at 25 PE. Now, if you invest in 1992, when index has already exceeded nominal GDP by a wide margin, and you made the mistake of buying in 1992, so I think index is perfect. Over long periods, that's what I said. So I don't think there is any demerits in the index.
Yeah, no, I support Prashant's, because if you go to the S&P BSE 100 BSE website, you can actually download, that's the exercise I did last night or before coming here, and you can find out, I think the data is starting from 1979 over there. So let's go quickly to this question on the...
There's more questions? Or?
Yes.
Yeah.
Okay.
Hi, good evening. I'm Sneha. Sir, I had a question. So, Indian pension funds have recently permitted to invest in Indian equity indices. So, with the currency depreciation happening, like, what are your views on it?
See, it is very simple. You buy Indian index, there are two components of returns, real returns and nominal returns. The real returns of the index is equal to the real growth by and large. India is a high inflation economy. That is why the currency depreciates. So when we are talking 15% CAGR, that is in rupee terms. When you say 9% in a bank FD, it is in nominal terms. But from that you must reduce the inflation, and let's say inflation is 6%, then your real returns on equities is 9%, your real return on bank deposits is 2%. So your purchasing power is increasing between 0 to 2% in bonds, and between 6 to 9% in equities. So I don't see anything wrong with it.
So
But it's part of, I think her question is part of something else that, somebody else asked. I mean, Indians are not going to go international because you're not even domestic yet, right? At some level, get into domestic stocks first before you go international. But there is also this sort of notion, academic notion of home bias in equities, right? People buy what they understand. They understand what is traded at home. And so, US investors would really be worried. My friends, when I was in the US, would tell me, you're buying Indian stocks. What's wrong with you? Don't you know they are risky? And I'm like, no, yeah, some of my IIM friends are managing those companies. I know they're not risky. So that kind of notion is always going to come into play, right? And, but I think her question was also more to do with, the provident fund guys. These are huge portfolios, and I know this, I did a program for provident fund people, and, EPF has recently been allowed to go into equities. And they put, what is it, 5%, 5% of new inflows of 70,000 crores go into equities. And you know what the guys who are in the program asked me? They were like, sir, we need advice on an exit strategy. And I'm like, bhaiya, abhi to enter kiya nahi hai, kahan se exit karoge? And that's kind of where it stopped, right?
Just one more point, meaning, one of the massive problem that US and Europe today is facing is their pensions are grossly underfunded. Right. Yeah. And I think we've been facing some of these challenges, the EPFO and all of that in India, because with your rates coming down and the kind of returns they've delivered in the past, in the last 20, 30, 40 years, and interest rates have come down very sharply, they're struggling to deliver those kind of returns. Yeah.
They're struggling. Absolutely.
Globally, if you see over a long period of time, again, I see you go back to world history over the last 100 years, 200 years, the only asset class which has beaten inflation and delivered substantial positive return over a long period of time, despite cycles and volatility, is equities. So if you want to generate positive real return over a long period of time, to my mind, the only asset class that's there is equities. Now you can have different variations of that, doing private equity, doing public markets, and all and so on and so forth. But fixed income at best can deliver you returns which will be slightly above your, inflation. So your real, meaning, in fact, today we live in a world where real interest rates are negative in most of the world, most part of the world, because of central bank actions and the extraordinary monetary policy that we are witnessing in large part of the developed world. Yeah. So just imagine a situation where you have negative real returns on your fixed income, and if all your pension and retirements and provident funds are in, in fixed income, effectively you're losing purchasing power every year, because interest rates globally are, suppressed because of the extraordinary monetary policies of central banks. Meaning central banks have been very adventurous. Some of the most adventurous central banks, like Bank of Japan, have gone to the extent of, meaning they're manipulating equity markets, the way they've gone and bought into equities in Japan. So all I'm saying is the only asset class, you don't have a choice with that. You don't have a choice with that. Meaning the only asset class which can deliver you meaningful, positive real returns over a long period of time is equities.
So shall we go? We've got 5 minutes left. Yes, sir.
Maybe we should take questions and then go have high tea.
Yeah.
Such as it is. Yeah.
Now look at just year horizon. I mean, if you just want to look forward to what's likely to pan out in the next 9 months, 1 year, right? The last 2 days are a little dangerous for us, right? We have tanked quite a bit of,
Short-termism karna chahiye.
Right. I mean, we've lost quite a bit of steam that we were seeing, and the upward trend that we were looking at, and this coming in a regulated sector like housing, finance, etc. How do you see the politics weigh on the Sensex in the next 1 to 5 year term?
Just I would like to flip the question a little bit and address, see if Prashant and Pankaj and Professor Badri can address this question of short-termism, day trading. You get on the TV every day morning, buy this, sell that, and sir's question as well. So can you please reflect on this very quickly? We've got 4 minutes left.
But I also want to look at a year horizon, and this coming from the regulated sectors, right? I mean.
See, Buffett, he says in the short term markets are weighing machines, in the longer term they are voting. Yeah, in the short term they are. And so as I said, there are human beings involved. Human beings, unfortunately, while everyone thinks he's acting rationally, most of the time they end up, behaving irrationally. So these kind of things do happen. For an investor, the biggest edge which a long-term investor has is, this kind of distortions that happen in the market. Meaning, I always say that for me, what has helped me all my career is I pray to God that there is one crisis every few years, because that's what helped me professionally. If there were no crisis, you don't need a professional manager. If you don't fall sick, you don't need a doctor. If you don't get into litigation, you don't need lawyers. If you don't fall sick, you don't need a doctor. So, every profession. So all I'm saying is crises will happen, and they'll keep happening all over the world, because something or the other will keep going wrong. The question is how you respond to that and how you react to that, and what's your investing process and discipline. So that's the broader perspective. Just coming to next 1 year, I don't know how it plays out over the next 1 month or 6 months. I certainly know one thing, that I feel pretty excited about Indian equities. It's after a long time that, we're seeing acceleration of growth in India, and the kind of structural reform that has happened in India in the last 3 or 4 years are really game changers. So my view is that over the next 3 to 4 years, India's growth is going to accelerate big time. People talk about this, election cycle and all of that. If you go back in history, right from 91, I'm saying 91 because that's the time when we started our journey of economic reforms. India's best periods of growth have been under coalition governments. So what we intuitively believe, the data is exactly opposite of that. So all I'm saying is every crisis is a great opportunity. If you get corrections or vicious corrections, then that's a great opportunity. In terms of the point you're referring to, you made 2-3 questions in that, you said something about the regulatory, this thing about, markets always have this herd mentality and this behavior where they behave very violently in the short term because there's panic out there. There are retailers, HNIs, and there are margin calls and stuff like that, which accelerate the whole, will precipitate this action either ways. And these days you have what you call algos and all of that in India as well. So the response is very ferocious. I think regulatorily we are still a well-regulated this thing. We have regulators, be it the central bank, the RBI, or regulator, meaning they've always done a great job. It's a one institution can have some problem, but that does not mean that, and I don't know exactly how deep is the problem. I can have my sense, but keeping that aside, that doesn't jeopardize the market or the system. I think the system or the market are absolutely fine, and I don't see any issue with that. There can be issue with a specific company. Now that's left to that company and their shareholders and so on and so forth, but that doesn't mean anything for the system. And when some of these things go wrong, you get your best opportunities to buy some great businesses at prices which would not have been possible otherwise, So
right.
Like he said, Harshad Mehta and Ketan Parekh are his best friends. I think crisis, for a long-term investor, crisis is your best opportunity. So always wish for a crisis every few years, But for crisis, you would not have made extraordinary returns.
Right. So I just wanted to see if Prashant can give 1 minute response. Oh, okay, yeah. Yes.
He has a flight to catch too.
Yes, sorry.
He has to catch the flight too.
If you look at 1 year returns from the day Sensex started, in roughly half the year, Sensex has given positive and the other half negative returns. If you look at 5-year rolling returns, in only 5 out of 35 5-year periods, returns have been negative. If you look at 10-year periods or 15-year periods, returns have never been negative. So the moment you think short-term, equities are simply volatile. You toss a coin, no one can say it is head or tails. You look at the markets 1 year, no one knows whether they'll go up or down. So I think we should not think short-term. That is the key to great investors in equities, thinking long-term ability to tolerate volatility in the short periods. Your second question was on NBFCs. See, NBFCs have gone up very sharply. Any sector which gets overvalued will correct over time. Now that correction could be in the form of some small crisis or a big crisis or some trigger. And I think some of these spaces have done exceedingly well. And I think they did well in a time when interest rates were very low, liquidity was ample. Banking has two sides to a balance sheet, liabilities and assets. These NBFCs are weak on liabilities, and now money is becoming tighter, liquidity is becoming tighter, and valuations are expensive. So I think markets are taking their course, but I don't think we need to worry about it from a regulatory perspective.
I'll just make one more point here. When it comes to business of equities, this is nothing but meaning there are two aspects. One is investing when in terms of buying underlying businesses, other is stock prices. When it comes to stock prices, what's out there in market is nothing but crowd behavior. Yeah, bull markets and bear markets are as natural phenomena in equity markets as you have weather patterns. So you know that if after every bull market there'll be a bear market, and after every bear market there'll be a bull market. If you can reconcile to that, just like we don't respond so in such an extreme manner to changes in weather patterns, that after autumn you'll have monsoons, after monsoons you'll have a fall and a winter. So I think these are, if you're a long-term investors into equities for the next 30, 40 years or the rest of your life, you just have to reconcile that's how the behavior patterns of markets are. And once you reconcile to that, then every time you see a cycle or a crisis, meaning you have two choices. Either you can be victim of that crisis, or you can position yourself to benefit out of that crisis. Now the choice is left to each one of us. How do we position ourselves? Because there are people who benefit out of a crisis, and there are people who capitulate or become victim of a crisis. So I think crisis is not such a bad thing to happen. And we should not hate crisis.
All I have to say is please don't day trade. That's it. It's just not going to work in the long run. And what? Or the NSE, actually, since Vikram is not here, I can say that, right? You're generating trading volume, right?
All of you must have studied derivatives, right? Can you make money out of derivatives? No, what is a derivative? You are trying to forecast the outcome of a stock price over the next month or so. So all of us know, see, what is a casino? In casino, who makes money?
The house.
The house makes money. So what are derivatives? There is a cut on every trade. The broker takes away the commissions. There are some taxes out there. So, but still, the derivatives volumes are more than the spot market.
No,
why?
and retail in India, retail
So why?
volume in Nifty
So
options
why?
is crazy.
So
I
why?
don't understand
So
this.
it is very simple. Sir. People don't understand equities.
So you
They
do
think they
stocks, so you
understand,
do
but I
options.
said it takes 10 years, few mistakes to realize that what you don't know. So the best investors, the smartest are long-term investors.
No, absolutely.
Every time you're buying a stock, please bear in mind, if you're an investor, you're buying minority ownership rights in a business. So you're not, stock is just a mechanism to make it easier. So it's more like buying a business. The question you need to ask is, do I think that's the most exciting business or the most favorable business? And do I want to own that business for the next 5 or 10 years? Meaning, is it a great business to own? Are the best people running it, and so on? So while, meaning we can say that we are buying a stock, but eventually what you're effectively buying is minority ownership rights in a business. So there is an underlying business to it, unlike meaning derivative, which is more a financial product than having any underlying real economic activity. But when you're buying a stock, you're buying something which has underlying economic activity underlying it.
Yeah. We have flights to catch, I think, too, right? Are you okay? There is chai, there is tea and stuff to be had. Are there any more questions, or should we? Yeah, last one?
Last one? Okay.
Okay, go.
Thank you.
We have time.
We can take a few more, fine.
Okay.
What time
Thank
is
you for
the flight?
accommodating the questions.
Okay, 10 more minutes.
I was
Thank
just
you, guys.
curious because I'm a student pursuing MBA right now, and I've been thinking and investing actively. But both of you have mentioned about disciplined investments or disciplined actions. Can you give an insight of what that is? And also another point that I wanted to ask and clarify, because there's so many high frequency trades and all of that happening with 90,000 or some trades per second. Is it still possible for students like us who have very limited time on a daily basis with very limited amount to really make money? And if that is the case, what discipline approach does it require?
So we need to distinguish between, as you said, there are high frequency trades and investing. So when you talk about a trade, essentially you're trying to buying a financial product with an intent. If you're buying or selling it, that you'll be able to, if you bought it, you'll be able to sell it in the next few hours or next few days to someone else at a higher price, or if you've sold it, you'll be able to buy it at a much lower price. And you're just trying to take a punt or a very short-term view on a financial product. When it comes to investing, I think it's a very serious business, because essentially you're buying an underlying business if you really think about that. And that's what true long-term investing is all about. When we talk about investing discipline, financial markets go through their own cycles, as we've seen, and all of that. Investing is a serious business where you need to have a sound understanding of the underlying business you're buying, understand what are the drivers of that business, how good is the management of that business. A lot of businesses get disrupted over a period of time and they cease to exist, and so on and so forth. So you need to have a sound understanding, and then you need to have an understanding of the value you're paying for that business, or the price you're paying and the underlying value you get. And there are times when markets are irrationally priced, and which is why we get these boom and bust cycles in markets. So what is most important in investing is to maintain that discipline, one, in terms of your behavior, in terms of when markets are irrationally priced, probably you'll sell stocks and not buy. Usually it happens that on those such extreme ends of the markets, when markets are irrationally priced, you'll have a lot of news flow, either from news channels or newspapers, or from your friends or from your dealer broker, who'll say, that's the most attractive stock to buy. And probably for all you know, you're buying those stocks at the peak of their cycles. And from there, over the next, when you get the next cycle.
Yeah, no,
I just want to tell you, share one thought with you. See, there is wealth redistribution and wealth creation. What Pankaj has been emphasizing, if you buy a business which was making 100 crore profit 10 years back, and due to growth, if it is today making 400 crores profit, the value of that business has grown 4 times. So anyone who bought that business 10 years back, anyone, he has made his wealth 4 times. But what algos, what derivatives are all about, they are about redistributing wealth. So what is an algo trade? What is a derivative? It is saying, I will buy this put or call or this futures or options, and in the next 1 month, if the price goes above this or below this, I will make some money. But just think of it. For every such person who makes money, someone has to lose money. Right? So if you try to time the markets and make money out of timing over 1 month, 3 months, whatever instrument you adopt, it is about wealth redistribution. You can make money provided the counterparty loses money. So now you are saying whose timing is better, yours or his?
and you might even get it right for a month or 2, but it's going to catch up with you, right?
Actually, if you lose money in the first few months, believe me, you are blessed. Seriously, I'm telling you. So you are blessed, because if you lose money, then you will lose faith in that approach and you will do well. The biggest misfortunes have happened to people who have struck 10 heads in a line and they think they are great timers, and then they end up putting 100 times the money where they started and they go bankrupt, and that is what happened to some of the names. So I think the moot point is, the key point is, think of equities as buying businesses, and you will make as much money as the business grows. When Infosys went from few thousand crores market cap to few lakh crores, anyone who bought that business made money because wealth was created.
Right.
So don't focus on wealth redistribution, just focus on wealth creation. And the only key point left here is, if the business is discounting 10 times growth in the next 10 years, the business may grow, the stock may still not grow. So that is the only part you have to focus on, that the business should not be overvalued. Like if you bought Wipro in 2001, the business has grown significantly, but the wealth has not grown because the stock was discounting the next 20 years of growth. And that is typically what a bubble can become. So that is the only situation you have to be careful about. Yes.
No, I think we should call that a, is there any more questions? If not, I think we should say thank you to our guests for being so generous with their time.